Hello, folks. This is George Abadova with Bellalago Experts, powered by LPT. And if you haven't yet bought this book, and I had made this a few years ago, you are losing a lot of not only great information, but you are losing thousands upon thousands of dollars on your mortgage payment. Now, I have it on the board, but I want to go over the history first of financing so you can become better educated. So please stand by because I don't want to give you this is free. I don't want to give you this information without you understanding first how everything, the history of it, how everything came about. You know, there are a lot of stuff we may have heard in life. A lot of the history is exactly that, his story. It ain't true. But I'm going to go over some information here, and I want you to follow me, and I'll show you. I will give you the information. If you're a veteran, listen to me very carefully. So let me give you a little tidbit right now. Mortgage are very high right now. The word mortgage in Latin means death pledge. So they want you to keep you in debt indefinitely, right? However, I want you to understand that when you do stuff creatively and learn how to use other people's money, you end up getting out of poverty a lot quicker and out of that death pledge. So that's what I want to teach you today. But I want to show you on the history. So please stay with me. But also, again, if you are a veteran, think about this. There are a lot of properties right now that have a VA loan that are for sale. And technically, a VA loan is assumable, as you know. So you could assume the mortgage. For example, I myself have a property, beautiful property, for $470,000, but the mortgage interest is 3%. So if you assume the mortgage, you're paying less than half of what you would pay by conventional means, right? With today's interest rate, almost 8%. So follow me here, and I'm going to take you through the history of financing so you can become well informed. I want you to understand that before the Housing Act, back in 1934, okay, stay with me here. Mortgage used to be a balloon payment of 5 years. So it used to come with half the mortgage payment, used to come half of the mortgage payment, and then what happened was you have 5 years to make a balloon payment, right? Make the rest of the payment. So you would pay either interest or part of the principal until it was paid in off completely. Well, right before 1917, I want you to see this. The government created the Federal Reserve, which was 1913. Now, I want you to understand something. That's when the IRS, right after that, was created as well. Now, I want you to understand that the Federal Reserve is it's not federal. It's not a bank. Okay, it was powerful people that our constitutional fathers, when America was founded, did not want, because it happened back in England, in France. They were at war with each other, and they were funding basically both sides of the war and became very wealthy. So our founding fathers knew that. So they did not want a centralized bank here. And for sure, they did not want neither IRS, for example, because it created an issue regarding your privacy, and they wanted to keep what you had and own private. The only time the IRS was used before it was implemented again in 1970 time was during Abraham Lincoln in the Civil War. That was used for 10 years to fund the Civil War. Okay, but it was quickly taken off again because they did not want it. That they know what happened with England and France and many other nations, where these people used to give out loans, right? They hide under different religions, especially the main one, but they're not religious at all. They just use that, but they have created financial industry that has put us as an indentured servant. So I want you to understand that. And just to give you a little comparison, I want you to look at 1970. In the 1970s, there were less taxation and the dollar's buying power was much more. Wages has not kept up with the inflation at all. So we are eating our wealth away, right? And the dollar's buying power is diminishing. It's like a Ponzi scheme, and eventually it will collapse sooner than most of you think. Now, if you look back in 1970, the minimum wage was $1.45. And if you are on a minimum wage employment, you will get $58 a week. Again, this is 1970. Now, on a month, on a minimum wage, it was $251.33. Granted, most people on an average income were not 253. They actually was getting 3,016. Okay, and the average income was 9,870. Now that's per year, guys. Okay, what that means is that in a year, an average income of 9,870, as you can see here, A new house that was bought back then was for 23,450. You can Google this, research it. So the point is that your income, right? It was a house was 2.4 times more than your average income. Think about that. So if you wanted to pay off the house within a couple of years, you had that ability, right? If you say, now think about this again, because back again in before the Federal Reserve was created, a lot of people that used to buy the property, especially in the 1920s, they used to get a loan, again, 50%, and was able to pay it off within 5 years. Now, I don't want to get to further years yet, but the point is that something happened. We all know about 1929, right? Think about this, 1913, the Federal Reserve Bank was created. A lot of nations borrowed from the United States because we became the number one lender, and I'll get more into that later on. But the fact was that back in the Great Depression, 1929, America filed bankruptcy, and that created the Great Depression. A lot of people don't know that. We were USA sovereign, and we became a corporation. Now, you could verify this or you could deny it, but let me go you about the history that happened. So, just so you know, houses were 2.4 more than the average income. Now, I want you to compare it with the year 2024 today in the state of Florida. This is all in the state of Florida, by the way. The minimum wage now is $12 an hour, which equals to $480 a week. In a month, the minimum wage is 2,080. So there's a lot of minorities, as you know, that are in a minimum wage income, 2,080 or just a little above that. All right. Now, on a minimum wage in a year, that's 24,960. Technically, that's the poverty line. But according to statistics, the actual average income in 2024 is 55,980. I assure you, I know a lot of people in Florida. A lot of them do not make that, and I'm talking about from medical technicians to many others. They're not making that right now, but nevertheless, the stats shows that it's 55,908. What that means now, I want you to understand this. If you recall from before, a house costs 2.4 more than the national average income. Well, think about that, because even so, here, 55,980, a new house built, the average right now in the state of Florida is 430,000. That means that it's more than 7.5 times more than the average annual income and growing. Okay? It's actually 7.68, and you can verify this. So just so you know, also a fact here, the inflation rate from the 1970 to 2024 is 708.11%. So your buying power is diminishing. It's getting smaller and smaller. Again, the Federal Reserve Bank was enacted in 1913, and right after that, the IRS was enacted. It did not exist again until from Abraham Lincoln, as I explained before, for only 10 years. Now, that created a lot of issue because now I'm going to explain more how America started borrowing from the Federal Reserve Bank, which has 12 members, which are owned by who? People say it's owned by 12 members who are corporations. You got to see who owns these corporations, other lenders. Okay? They'll tell you they have the governance and all that. If you look up, us, U.S. United States of America has no jurisdiction over the Federal Reserve Bank. Unlike what you may have believed, but 90 showed that once when they was in Congress, it showed that we have no jurisdiction. In other words, we can't tell them exactly what to do, as most of Americans believe. Now, in 1929, the USA filed for bankruptcy in the beginning. That's the beginning of the Great Depression. And in 1934, because again, those people that took out loans for 5 years, when it came due, balloon payments, they didn't have the money to pay. So what happened was the government created the National Housing Act in 1934. I also want you to understand that Social Security Act, right, which is another Ponzi scheme, was enacted in August 14, 1935. So the Federal Reserve Bank used this opportunity. They were lending money, created a lot of inflation, and obviously America went bankrupt, okay? And they actually filed in 1929 and was actually finished in March of 1934, okay? So 1933, sorry. Now I want you to understand this, because look at this now. The national debt right now is 34,794,120,000,000 and counting. Now, if you divide that by United States population, we're talking about over our population right now is about 336,505,850. If you divide that wealth minus what we produce, you're talking about over $75,000 per citizen. Okay, that including babies. So Right now, I read something and I'll show you here. I want you to look up what is called the United States debt clock, and you can see it right here. This is our national debt. Okay, so right now we are 122.28% over the GDP. For those that don't know what GDP is gross domestic product, is what our nation produces and sell. So in other words, think about your income. If you make $1,000 income, for example, right, you cannot pay a rent of 120%, right? 1,200, because it's impossible. That's where our nation is at, guys. And I don't want to scare you, but the fact of the matter is that we can't even afford the interest on our debt. So for sure, the dollar will collapse. Okay, there's more to it, and I'll explain it. But I also want you to understand there's a new system, BRICS, right? BRICS, which stands for Brazil, Russia, India, China, in South America, and there are many other Latin nations joining them as well, and they are dumping the dollar. And I can't explain too much of it. I'll explain it later, but I want you to understand it because that's going to create a major issue. And what happens, as we do before, when you threaten the dollar, that's our American interest. We fight for that, right? Like we did in Iraq, like we did in Libya. Okay, when they wanted to turn and trade in gold, we went and did what we did, and we'll create issues about saying this for our democracy. You see what's going on right now in Israel. It's not about democracy. They're not representing us, the people. They're representing their interests. Okay, there's a few group of elite people that they're representing. Okay, so now I want you to show you something, because if you purchase a home at 500,000, putting 20% down, right, which is $100,000, thus a loan for 400,000 for a term of 30 years or 360 months at 8% interest rate, the mortgage payment will be 2,935 per month. Now I'll show you an amortization schedule. So if you have a chance, I want you to pull out your closing documents along with your amortization schedule so you can verify that what I'm saying is true. And I want you to look at your numbers, okay? But today I use 8% interest rate because that's what's, is more or less about 7.5, 8%. Sometimes it goes a little higher. But in the first year of you making mortgage payment of 2,935 per month, you're going to see 12 months, you will have made payments of 35,220.72. You can do the math, right? 2,135 times 12 months equals that much. Now, out of that amount, guys, you will have paid towards the bank, your lenders, you're paying rent for the money you borrowed. You will have paid $31,879.05 out of 35,000 payments that you made throughout the year. And only out of that amount of 35,000, you will have applied $3,341.45 the first year only towards the principal. So if you borrow again 400,000 because you put 20% down, right? You will only apply 3,341, which gives you a principal balance of 396,658. See that? Second year, 24 months, you have paid a total of $70,441.44, of which of that amount, $63,480.95 went towards interest. And only towards principal within those 2 years will be $6,960.49. So your principal balance will still be now after 2 years, $393 and $39.75, where you already made payments of $70,441.44. See, you're paying first for interest. So whenever you see an interest, for example, in this case, 8%, what you want to do is double it. Okay, 8 times 2, which is 160, right? 8 times 2, I'm sorry, 16. Put a 0, that's 160. So you're paying your bank's house first before you pay your own house. You pay interest first. So I want you to understand that, because they know, this is why it's called death flash or mortgage. They know within 5 to 7 years, most likely you're going to relocate or refinance, and you're going to start the amortization schedule again, getting you back into debt. So in 33 months, you would have made, okay, and this is what I'm saying, because I want you, if you went and applied $10,000, I want you to show you how long it will take for you to reduce that amount in the amortization schedule to reduce 96,856 of payments. You will reduce $86,986.60. They would have paid towards interest to have a balance more or less of 390.29. And I'll make my case here. I'll go here and I'll look at amortization. Check this out. Okay, let me find it. Okay, here it is. So you see right here, this is 500,000 at 8%, $100,000 down payment means the loan amount is 400,000, 8% for 30 years, and you yourself have what is called an amortization schedule. So here's month one. Your mortgage payment are 2,935. Your principal paid on the first payment is only 263 or 268.39, and you will have paid 2,666.67 cents. That's the first month, right? And you still have a balance of 399. Well, if you go down, as I mentioned before, 12 months, that's a year, okay? You're still making those monthly payments. You would have paid, uh, um, you have a balance of 396,658. So notice, 24 months and 33 months. There you go. Okay, 390,000 more or less. So if you what I'm trying to convey here is if you were to apply $10,000 from a home equity line of credit or a credit card that you get, for example, with zero APR, right? The banks got slick. This is why they don't lend you a lot of home equity line of credit unless you pay down a certain amount. Or the credit cards also, when you do cash advance, right? They want to charge you a astronomical interest rate. But I want you to understand something because the mortgage that you pay is not 8%. It's really 160% of what you borrow. They're charging you, as you know, interest first. Okay. And if I show you, if I go back to my book here, at this time when I wrote this book, The No BS in Making Millions in Real Estate, right? This is the book you're seeing on the screen right now. And I'm going to open this up a little. This is at 6.5% on a $300,000 loan. So I did this already for you so you could see it. It's on the book. All right. And if you go over here, you can see that the mortgage payment is 1,800 right here, 1,886.20. Okay. At a 6.5 interest rate, 1,896.20 times 12 months equals 22,754. So when we go back to this amortization schedule that I did here per year, not per month, you will see that the first year you will apply out of 22,000 and something, you would apply towards interest 19,401.18 and only apply towards the principal, the initial money you borrowed, 3,353, giving you a balance of 296. That's the first year. This is the second year. You owe 293. Okay. So look how much interest you apply. This is the number. Look at the third year. So if you notice, all you are paying first is interest, guys. Interest. So if you went and applied on your mortgage here $10,000 by using a credit card, you will save yourself on a 6.5% interest rate. You want to bring it down to around right here, 289. You will save yourself about 57,515. Now, you may ask, but wait a minute, the interest card or the credit card has a higher interest rate, for example. It doesn't matter because the way the mortgage works is whatever money you borrow, you're being charged interest on a daily basis. Okay? Now, unfortunately, they will not allow you to make a payment, right? Until the end of the month or beginning of the month after 30 days, and you're going to get charged all that interest up front. Now, keep in mind that the same lenders that created all these industry, they own the medium. So they will lie to you, and I'm sure you heard it many times before. Oh, it's the same if you make a full payment at the end of the year, right? How many of you have heard that? That's a lie, okay? Because you're being charged interest every day on that amount, but you make the monthly payment. So if you wait till the end of the year, you just paid a whole year worth of interest before adding that extra payment. So if you could borrow other people's money, OPM, get a home equity line of credit, for example, or zero APR credit card that has an introductory rate, and you borrow $10,000, you apply towards your mortgage principal, you reduce years of your mortgage, right? And keep in mind that the credit card, right, charges you interest after 30 days. So what you want to do is you want to keep your average account very low. So how do you do that? Because you're not, if you put $10,000, you're going to owe $10,000 on the credit card, right? But remember, the interest rate is on a small amount for the entire year. You're not going to have, being charged interest every day because you want to lower what the principal balance you own that card. And how do you do that? By keeping your average balances low. How you do that? I'll show you more, so please stay tuned. So let me go back here. Okay. See here on this one here, 33 months. If you apply $10,000 on the $500,000 on property, $400,000 loan, you will save yourself 86,986. And I did that so you can compare apples to apples on an 8% interest rate. So let me give you an example here. See, this is a NELOC or credit card, as you see here. As an example, if your income was 9,800, as you see here, and assuming your mortgage payment as above is mortgage payment is 2,135, utility. I'm sure you got your own bills, right? But you gotta do your monthly balance. So all this you will pay throughout the month, right? All these bills you will pay out throughout the month, which is 7,655.06 as of this example. That's on a monthly basis. But your money is not working hard for you. You're working hard for your money, but your money's not working hard for you, right? The money's sitting where? In a checking account. So if you apply this money here, and if you got paid, again, $9,800, maybe with your partner, maybe by yourself. Keep in mind, back in the days, if you're old enough like I am, you remember we used to get paid weekly, right? Now we get bi-weekly. But if you have a partner and a spouse, and you both get paid on different 15 days, right? That money's sitting in the account, not working hard for you. However, you put that money into the home equity line of credit. It's going to reduce the $10,000, and then you start making payments on what you owe, which is 7,655. Those are your monthly expenditures. But the remainder of the time, the money's working hard for you. Isn't that account? So therefore, they cannot charge you on a credit card, for example, 12% on $10,000 because you reduce the amount you owe until you start making these payments from your home equity line of credit, right? Nevertheless, the total bill is 7,655, and if your income is 9,800 and you're applying that towards the home equity line of credit, you will have that card paid off in 5 months, right? 2,000, 2,000, 2,000, 5 months, and you still have some. And then what you do is you start again. You borrow again $10,000 from a home equity line of credit, and you apply it towards the principal, and you keep reducing the amortization schedule. Okay, you keep reducing the amount. So, for example, let's go back here. Okay, so if you went again in year one, this is 360 months, all right, and you apply $10,000, that's going to bring you all the way down. You're going to skip all this, all the way down to right around here, 390, which is you're going to save yourself 33 months of payments, guys. But you're going to save yourself, as I did before, 89 something thousands of dollars. So now that you pay your card off, okay, within 5 months, you want to come again and apply another $10,000, okay, and that is take another $10,000, all right. So that's going to take you somewhere around 380, right around here. So you see, you jumped already another 50. It was 33 before, right? 33. So you skip another. What is it? A little less than 30. 27 months, right? To create 60. Think how many months and years you're taking off the mortgage, and if you do that, you will reduce your mortgage payment and your term for maybe about 6 to 7 years, doing it this way by simply not applying extra money, just moving your money along by using your home equity line of credit or zero APR credit card, right? If depending on the interest rate that they allow in the cash advance to pay down some of these bills or pay down the mortgage, right? $10,000, apply it, and then you make your payments on your card. You're going to reduce years of compounding interest. That's the secret. The lenders have lied to you. They have confused you, and I want you to understand that because we are not savvy enough or financially educated enough to understand this. Therefore, we're losing our life. We are becoming an indentured servant, and we have become an indentured servant ever since 1913. Okay, and then in 1933, when we actually closed the chapter, the bankruptcy, we became indentured servant. We became the promise to pay. How? For example, when you come and you're born, they know that most likely you're going to start working in your 20s all the way to your 60s. So you're going to give them a good at least 40 years of employment. And that's how you pay the taxes, the IRS taxes. Okay. Now, other countries, for example, China, right? They have their GDP, gross domestic product. They sell because back in the days, we used to have to trade for the dollar. They will grab whatever surplus they had and invest it on treasury bonds. Thus, that's lending us money, and we will give them, let's say, for example, 4% for a 10-year bond, right? However, Chinese and many other countries saw and became smarter because they saw what we were doing is we were giving 4%, but the inflation was above the 4%. So technically we were robbing them. And a lot of countries became savvy to the point that they created their own system. Because again, our dollar used to be backed by gold until 1971 when we took it off the gold standard Brentwood system. And basically that's what happened. And I'm going to go over a couple of things before I finish because this is very important. Okay. I don't know if you can see this, but if you see the prospect of default is certainly unthinkable. However, the United States has defaulted on its obligation before it happened, and it happened again in 1971 under President Richard Nixon. Okay, we closed the gold convertible window and severed the link between the United States dollar and gold. Back in those days, guys, $35 of an ounce was backed by an ounce of gold. When many countries started claiming back their gold, okay, we didn't have enough money to pay them. So we severed the dollar away from the gold and we started printing more money, creating a hyperinflation. You saw how the properties went up in value, how our buying power. Well, when you mix fake dollars by keeping printing with real dollars, our dollar loses its value and then we get what is called hyperinflation. Okay, so the problem is a lot of these nations now are coming to collect and we don't have enough money to pay them. And when other nations see that we don't have the funds to back it up because we are in debt more than we produce, that's going to create a major depression, guys. So me personally, if you have any 401ks, IRAs and all that, honestly, I think they're going to tap into that Social Security. They're going to tap into that money and they're going to use it to pay their bills. They're going to go bankrupt and you're going to be without funds. I've seen it before in other countries, including Ecuador, when they came to the dollar. It's going to happen a lot. And I want to say a little, I want to, you all explain a little bit more about the history. See, back in World War II, even World War One, many countries, all right, they started trading with the dollar. And then in World War II, I want you to understand that back with Germany and many other nations, because of war, millions of people were killed. They were dead. Think about the farms area, right? Shooting with machine guns, all the bullets all over, messing up the crops. Many men died. So all that was left was women and the children's. Who's gonna get on a tractor trailer or on those things on the farmer to create for the food for the family? So what they had no choice, and what they did was they borrowed from what they thought was America, which is actually this corporation, Federal Reserve Bank. They borrowed, and because of that, they traded their dollar for our dollar because our dollar was backed by gold until 1971. Okay, I want you to understand that when you saw right now what Nixon took it off the gold standard and severed that. So our dollar was measurable, right? It was backed by $35 dollar by an ounce of gold. So we could measure with other countries. And we stopped and then we started printing more money. Okay, so think about this. Those kids that couldn't farm the area, eventually they were what their families did. They bought from America, and our country became very successful, especially after World War II, because we were selling a lot of goods to different countries. And then there's another issue when we got together with OPEC, right? Saudi Arabia, and they created OPEC, in which now the dollar became the petrodollar, which other nations, if they want their petroleum, right, for the tractor trailers, for heating their buildings and all that stuff, right, and running their factory, they had to buy oil. And in order to buy oil, they first needed to trade their dollar into what is called the petrodollar, right? Their currency for our dollar. Well, many nations, if they wanted to go against that, wars were created or people were taken out of power, right? We would put governments in place in many nations. This is a fact, guys. It happened in Iraq, it happened in Libya, and we have created chaos around the world, unfortunately. These people are greedy, all right, and it's affected our economy, and it's going to come to haunt us now because a lot of these nations are trading like a barter system among their own. They're creating an electrical currency among their own, the brick system, and they are returning all this notes that they borrowed, right? That they lend us, money that they lend us, and the notes they're going to come back and collect, and they're already doing it by the billions. 24 nations right now have dropped the dollar, and they're going to announce it in October, which means that our dollar, I hope not, guys, but it's going to come crashing down. So that's scary. So if you have money saved, I think, look, if you can't buy it out of this country, like in Latin America, like in Panama or whatever, then honestly, at least have your money in what's something that is real estate, okay? Because it's all going to come down. And if you could have it free and clear, even better. So this is what I'm saying, guys. And I think I give you enough information. I don't want to drag this longer. You can look at the history back in 1933. I have a lot of information here. As you're looking at the board, you know the stock market crash of 1929. You could hear a video here. I said the same thing. And I've been knowing this before he said it, by the way.
Yep. Okay. That whisper down the alley.
Yeah, exactly.
And we're like 100 years down that alley.
Yeah, just such subtle little things. So in response to that, March 9th.
So if you want to look that up, guys, if you want more information, I can send you the link. Look at history. Granted, there's a lot of things they don't want you to know. See, the Federal Reserve Bank was created in 1913, so was the IRS. A lot of people don't know, and we created more taxes as the decades go by. That means your buying power is less. So not only are you paying 50% on taxes when everything's said and done, you're actually paying more because the invisible tax is inflation. So you are becoming an indentured servant. It's going to get worse. And we are one of the highest tax nation in the world. It's not what it used to be. This is why a lot of Americans are leaving our nation. I believe in our constitutional rights. I believe we should fight for it. But what can you do? We see right now when a lot of people are protesting. I see that very bad when they were protesting against another country. They were being arrested, and they'll change the story around. They'll use the media to give you lies, and unfortunately, it's going to come to haunt us. Okay, and I believe that's maybe even treason. Right? Why are we sending billions of dollars to other countries when we should be supporting our own country? Here we have a lot of homeless, a lot of veterans that are homeless. There's a lot of things we could build to create jobs, like bridges, create, work on bridges on our roads. Keep in mind, because a lot of people confuse this. The IRS is one thing, and what you pay, for example, for cops, schools, and all that comes out of your property taxes. Okay, that's municipalities. Okay, and the tax assessor's office, based on the property value, they grab a 1.5%, all the way from 0.8 to, let's say, even 2% of the value of the property, and that's what pays the hospitals, the schools, the cops, the fire departments, the roads. So the IRS you're paying is for a debt. And yes, they use that for war, but this is why our constitutional founding fathers, you had to buy a war bond if you wanted to profit from the war, because they knew that if they had the citizens, or it wasn't citizen back then, but the sovereign people paid for it, you was going to rob them. And they did not want that. They only did it again back in the Civil War under Abraham Lincoln. All right, and they did it for 10 years, and they stopped it because they knew it was not better, because that was part of the Constitution. It was unconstitutional to have a centralized bank, for those that don't know. So, guys, I hope this helped. But keep in mind, if you're going to buy a property, I just showed you, grab a $10,000 equity line of credit, okay? Apply towards the principal, thus savings years of compounding interest. And since the credit card, you could pay on a daily base, on a weekly base, you will reduce that amount, right? You will reduce that amount, saving you thousands upon thousands of compounding interest in years of the term of your loan. Guys, I hope this helps. If not, keep in mind, there's great information here, especially it's on page 115 of the No BS and Making Millions in Real Estate. Buy it, and it will definitely help you. Okay? Again, pull out your closing documents and your amortization schedule. Verify this for yourself. Don't be fooled. Don't let them tell you, pay by weekly payments. Okay, at the end of the year, no, they're lying to you, because you're being charged interest on a daily basis, called per diem basis. Guys, thank you for watching. This is George Almodovar, a licensed broker, and God bless.